Hello and welcome back to our demo portion of Chapter 10, dealing with accounting for liabilities. Now, like I said in the previous Chapter 9 videos, apparently I was way too overzealous with the homework, so we're going to cut down Chapter 10 homework as well. You only have to do problems 10-2A and problem 10-4A. Guess what we're going to do in these videos? Problem 10-2B and problem 10-4B. Okay, so this should help you out. So I'm on page 519 through 520, and we have a company here. They have a number of bonds that are outstanding. And if you look on page 520, they tell us that in 2014 we signed 2 notes, and then in 2015 we also signed 2 more notes. So what we need to do is we need to prepare the adjusting entries for interest at December 31st, 2014. Okay? So what I'm going to do here is I'm just going to list the 2 notes, right? We have note 1 and we have note 2. Okay? Note 1 was $35,000. Note 2 was $16,800. Okay? The interest for each of these, 0.08 is the interest rate for note 1, and 0.09 is the interest rate for 0.2, right? And they tell us that note 1 is a 90-day note, and note 2 they tell us is a 60-day note. Okay? So what we need to do is book the interest, right? So the first one, note 1, was signed on November 25th, 2014. Okay? So I'm looking at this here. November 25th, 2014. We signed a note for $35,000 with an interest rate of 8%. What we need to figure out is how much interest did we accrue from November 25th, 2014 until December 31st, 2014. Okay? So let's look at note 1. It's a 90-day note. We signed it on, do it this way. We signed it on 11/25/14. Okay? And we are at December 31st, 2014. So we need to recognize what's our time period, right? We already got our principal amount. We got our interest amount. What's our time? Now, because we're calculating interest, instead of using 365 days in a year, we're going to assume 360 days in the year. Okay? So let's think about that. From November 25th to December 31st, how many days is that? It's 36 days, right? So we're going to calculate our time by saying 36 days out of 360. That ends up being, we'll just use 0.1. That's fine. We don't need to go out any more decimal places. So, to calculate the interest expense, I take my principal amount times my interest, 8%, times time. And our time is 360 days out of, 36 days out of 360. Our interest expense that we need to accrue is $280. So, notice right here. There we go. So notice right here, I already did our journal entry, right? We have, hopefully, this is just a review. How do we accrue interest expense? Super easy, right? We debit interest expense, credit interest payable. For how much? $280, right? So in this problem, or in this chapter, we're reviewing how to adjust our accrued interest, but we're tacking on another piece and saying, okay, now we have to calculate that interest, right? What is the interest amount? So it wasn't given to us as it was before. Now we have to calculate that, okay? So again, we have a second note that we need to account for. And the second note we signed on 12/16/2014. Okay? We signed note 2. It's a 60-day note. We signed it for $16,800. This interest rate is 9%. We need to figure out our time. Now the total is 60 days, right? That's the note's going to come due in 60 days. But from, that is not right. Bear with me here. There we go. So from 12/16 till 12/31, how many days is that? Well, it's 15 days. So we need to accrue 15 days of interest. Well, that's easy. 15 divided by 360, that gives me my time. I end up with 0.0417. Okay? So to calculate the interest expense, I take my principal amount times my interest times time. I get $63. So guess what? Interest expense is going to be debited for $63. Interest payable is going to be credited for the same $63. Okay? Now they tell us in part B, or item B, assume that the adjusting entries were made at December 31st, 2014. We did that. And that no adjusting entries were made during 2015. Prepare the 2015 journal entries to record payment of the notes that were outstanding at December 31st, 2014. So what we need to do now is figure out, okay, what time frame are we at? Well, we're at the time when these notes become due, okay? So let's look at note 1, because note 2. Note 2 is the shortest, right? We signed it on December 16th, 2014, right? We need to count 60 days from this date, and that's when they're due. So I already did that for us, just to make it easier. It's going to be February 14th. That's when note 2 becomes due, okay? So I need to figure out what journal entries do I need to make. Well, right off the bat, I got to get the notes payable off the books. So I'm going to debit notes payable for the $16,800, okay? In addition, I booked an interest payable associated with note 2. That's $63. I'm paying that as well. So I need to debit interest payable, $63. Okay? Now, we have some interest expense, right? Because we have interest from December 30 or January 1st to February 14th, right? So we need to figure out what is my interest, right? What is my interest expense? So again, we're in 2015, we're at February 14th, right? January I incurred interest, in February I incurred interest, right? So how do I calculate that? Very simple. I have my principal amount, which is $16,800. My interest that's associated with that is 9%. And I need to figure out my time. Well, from January 1st all the way up until February 14th, that's 45 days. So my time is 45 divided by $360. To figure out the interest expense for the 2015 time, I multiply my principal times my interest times my time. I get $189. So my interest expense that was incurred during 2015 alone is $189. How much cash did I pay them? Well, it's simple. I paid them the $16,900 or $16,800, the $63 of interest, plus the last piece of the interest of $189. That ends up equaling $17,054. So my credit to cash is $17,052. Okay? Now, I need to pay note 1. Note 1 was a 90-day note, right? So from 11/25, I need to count out 90 days. Okay? That ends up being February 23rd. February 23rd, I got to repay note 1. Super easy to do because I'm basically doing the same journal entry that I did for note 2, right? So what is note 1 on our books for? So I have a note payable for note 1 on the books at $35,000. I'm paying that now. I accrued interest on this back at the end of 2014. I accrued interest of $280. So I need to decrease my interest payable by $280. And then I have an interest expense, right? I'm going from January 1 all the way out to February 23rd, right? I already recognized 36 days of the 90-day note. So the rest of the time from January 1, 2015 to February 23rd is going to be 54 days. So I have interest expense 54 days worth. Well, that's easy for us to do. I know my principal amount is $35,000. My interest rate is 8%. I need to figure out my time. Well, that's easy. Equals 54 days divided by 360. I get 0.15. So to figure out the interest that I incurred, the interest expense that I incurred during 2015, I'm going to multiply principal amount times interest times time. And that should be $420, which it is. So I'm going to put that in my debit. Now, I'm paying cash. How much cash am I paying? Well, that's easy. I have $35,000 plus the 2014 portion of the interest plus 2015 interest on this note ends up being $35,700. That's my credit to cash. Oh, sorry, $35,700. Okay? Now, they tell us in C, prepare adjusting entries for interest at December 31st, 2015. Okay, no problem. So what did I do? Bear with me here for a second. Okay, so in 2015, I signed Note 3, right? Note 3. Note 3 is a 120-day note. Okay? I signed this note on 12/11/2015. Then I signed another note, Note 4. Note 4 is a 90-day note. Okay? The principal amount for Note 3 was $15,400. The interest rate was 9% or 0.09. For Note 4, which I signed on 12/7/2015, the principal amount of that note was $18,000, and the interest rate associated with this is 12% or 0.12. Okay? So now I need to figure out what are my interest expenses, right? So let's go with the first note. The first note that we have here is 9%, and it was signed on 12/11, December 11th. So I need to count the number of days from December 11th until December 31st. That ends up being 20 days, okay? So what's my time? 20 days out of 360. To figure out my interest expense, I just multiply the principal amount times the stated interest rate times time. $77. So I'm going to book this for Note 3. So this is going to be 12/31/15. I'm going to have interest expense for $77, and I'm going to have interest payable for the same amount, $77. Okay? Now let's figure out Note 4, excuse me. Note 4 was signed on 12/7. I'm at the end of the year, December 31st, 2015. How many days interest is that? Well, from December 7th until December 31st ends up being 24 days. So to figure out my time, I'm going to say equals 24 days divided by 360 gives me 0.0667. Okay, that's my time. So to figure out the interest expense for Note 4, I take my principal amount, $18,000, times the interest, 12%, times time. $144. So for Note 4, I need to accrue interest. I'm going to debit interest expense for $144. I'm going to credit interest payable for $144. And that is how you do problem 10-2B. And your homework problem 10-2A aligns pretty much with this, right? As long as you follow those same steps, right? Recognizing that, okay, I need to figure out how many days this note is. Book's going to tell you. But to accrue interest, I need to figure out how many days I've had since I signed the note till the end of the year when I need to book interest, right? What do we come up with here? 36 days, 15 days, 20 days, 24 days, whatever, okay? We always have to divide that by 360. That gives us our time. Then we multiply the principal amount times the interest rate times time, okay? If you have any issues with this, or it's as clear as mud, you know what to do. Just reach out to me, shoot me a text. I'd be happy to have a conversation with you going over some of these problems and answer any questions you might have. Okay? So thanks for tuning in, and we'll see you in our next demo video where we look at 10-4B.